After studying this module, you shall be able to understand the significance of international finance, differentiate between international financial management and domestic financial management, understand the need for different type of quotations, learn about the functions and objectives of IFM, know about the Indian economy and international finance. The finance manager is a key member of the top management team, as finance is the lifeblood of commerce. The responsibilities of finance manager are now much more than before. Earlier, he was more concerned with liquidity rather than solvency of the firm. Procuring of funds when needed was his primary responsibility. Now, he has not merely to see that funds are provided, but also to see that they are effectively utilized. Therefore, the finance manager needs a broader outlook. He has not merely to control the purse, but has to provide funds with long-range point of view. The amount of funds needed has increased substantially due to three reasons. One, many new industries are coming up. Products are becoming more and more sophisticated, needing more and more funds. Intensification of inflationary pressure. International financial management has a wider scope than domestic corporate finance and design to cope with the greater range of complexities than the latter. The reasons are as follows. Longer distance is involved, different currency involved, different rates of interest in different countries, the existence of exchange controls in many countries, different legal system in different countries, political systems may be different in different countries, different tax system in different countries, customs, conventions, and ethics differ from country to country. The greater degree of involvement of the firm in the international economic environment, greater are the complexities. The consequence of the above are as follows. Larger source of funds are needed, greater risk is involved, many sources of funds available, the company can obtain funds from both inside and outside the country. Understanding the significance of international finance. Firstly, the importance of international finance. Importance of international finance can't really be emphasized without understanding the importance of international trade. This is because corresponding to every transaction of goods and services, there is a currency transactions which gives rise to an international payment system. This system is a part of international financial environment, and the system becomes wider as the volume in trade and service increases. International financial significance cannot be exaggerated. It is, however, the core factor to successful business operations. It is impossible for any entity to achieve its full strength for success and growth in the absence of finance. We all are aware of the fact is that money is a worldwide lubricant that keeps the local and multinational enterprise dynamic in developing product, keeping machines and men in working, motivating management to create values and progress. As we know that globalization opens the market for major corporations to business into international market, but it also brings corporations to a variety of risks that they can face while operating in an international era, and in this regard, international financial management is the only solution to mitigate these risks and expose corporations to the whole world to operate in. World economy and growth of international finance. International financial management, or IFM, deals with the financial decisions taken in the area of international business. The growth in international business is, first of all, evident in the form of highly inflated size of international trade. In the immediate post-war years, the General Agreement on the Trade and Tariffs was set up to boost trade. It axed the trade barriers significantly over the years, as a result of which international trade grew manifold. Naturally, the financial involvement of the trade's exporters and importers and the quantum of cross-country transactions surged significantly. All this required proper management of international flow of funds, for which the study of international financial management came to be indispensable. Not unexpectedly, the second half of the 20th century witnessed the emergence and the expansion of multinational corporations. Normally, with the growth of international trade, the products of the exporter become mature in the importing countries. When the product becomes mature in the importing countries, the exporter starts manufacturing the product there so as to evade tariff and to supply it at the least cost. Thus, it would not be wrong to say that the emergence of the multinational companies was a byproduct of the expansion of world trade. Some developing countries had liberal policies towards the hosting of multinational companies. These countries have the tendency of importing technology extensively. As a result, their companies went international. Thus, the emergence of multinational is not only in developed countries but also in the developing world. And because of their operation, the cross-country flow of funds has increased substantially. The flow of funds takes place in the following form: outward in the form of investment and inward in the form of repatriation, dividend, royalty, technical service fees, etc. All this requires proper management, and thus the study of international financial management becomes a necessity. With growing operation of multinational companies, a number of complexities arose in the area of their financial decisions. Apart from the consideration of where, when, and how much to invest, the decision concerning the management of working capital among the different subsidiaries and the parent units become more complex because the basic policies varied from one multinational company to the other. Those multinational companies that were more interested in maximizing the value of global wealth adopted a centralized approach, while those not interfering much with their subsidiaries believed in a decentralized approach. The second half of the 20th century has experienced a vast magnitude of lending internationally, the movement of funds mostly to the developing world, and the reverse movement of funds in the form of interest and amortization of payments needed proper management. Besides, there were big changes in the character of international financial markets with the emergence of Eurobanks, offshore banking center, various instruments such as Eurobonds, Euro notes, Euro commercial papers. So the nature of the movement of funds became so complex that proper management became a necessity, and the study of international financial management became highly relevant. In fact, international finance management suggests the most suitable technique to be applied at a particular moment, in a particular case, in order to hedge the risk. International financial management and domestic financial management. International finance is a distinct field of study, and certain features set it apart from other fields. The important distinguishing features of international finance from domestic financial management are discussed. The first being foreign exchange risk. That is, an understanding of foreign exchange risk is essential for managers and investors in the modern day environment of unforeseen changes in foreign exchange rates. In a domestic economy, the risk is generally ignored. Why? Because a single national currency serves as the medium of exchange within a country. When different national currencies are exchanged for each other, there is a definite risk of volatility in foreign exchange rates. The present international monetary system setup is characterized by a mix of floating and managed exchange rate policies adopted by each nation, keeping in view its interest. In fact, this variability of exchange rate is widely regarded as the most serious international financial problem facing corporate managers and policy makers. At present, the exchange rate among some major currencies such as the US dollar, the British pound, the Japanese yen, and the euro fluctuate in a totally unpredictable manner. Exchange rates have fluctuated since the 1970s after the fixed exchange rate were abandoned. Exchange rate variations affect the profitability of firms, and all firms must understand foreign exchange risks in order to anticipate increased competition from imports or to value increased opportunities for exports. Political risk. Another risk that firms may encounter in international finance is political risk. Political risk relates to risk of losing or gaining from unforeseen government actions or events of political character such as acts of terrorism to outright expropriation of assets under the ownership of foreigners. The assessment of political risk should not only be done in countries where MNCs are currently operating, but also where it expects to establish subsidiaries. The extreme form of political risk is when the sovereign country changes the rule of the game and the affected parties have no alternatives open to them. For example, in the year 1992, Enron Development Corporation, a subsidiary of a Houston-based energy company, entered into a contract to build India's longest power plant. Unfortunately, the project got cancelled in 1995 by the politicians in Maharashtra, who argued that India did not require the power plant. The company had spent $300 million on the project. The Enron episode highlights the problems involved in enforcing contracts in foreign countries. This episode highlights the problem involved in enforcing such contracts. Thus, it can be concluded that the degree of political risk is colossal with international operations than domestic operations and is definitely more complicated. The next is expanded opportunity sets. When firms go global, they derive the benefit from expanded opportunities which are available. They can raise funds in capital markets where cost of capital is the lowest. Due to expanded operations, firms can also derive the benefits of economies of scale. The next is market imperfection. The final feature of international finance that distinguishes it from domestic finance is that world markets today are highly imperfect. There are profound differences among nations' laws, tax systems, business practices, and general cultural environments. Imperfections in the world financial markets tend to restrict the extent to which investors can diversify their portfolio. Though there are risks and costs in coping with the market imperfections, there is also on offer a large amount of abundant opportunity. Functions and objectives of IFM. Now, the functions of IFM. Firstly, finance function of global financial manager is not different from the financial manager of a domestic oriented company. The only difference lies in the recognition of additional risks and opportunities present in the global economy. In general terms, there are two broad finance functions of global managers. One, acquisition of funds. Two, investment of funds. These can further be categorized into two types of functions. Again, one, treasury function. Secondly, accounting and control function. Treasury function may be described as acquisition of funds, investment of funds, capital budgeting, tax analysis and planning, credit management, investors relation, cash management, risk management. The other class of function are referred to as accounting and control function, which consists of external reporting, financial management accounting, tax management, management information system, prepares budgets, preparing forecasting, etc. The objectives of IFM is that an effective financial management is more than the application of the newest business techniques or operating it more efficiently. International financial management is written from the perspective that the fundamental goal of sound financial management is shareholder wealth maximization. Shareholder wealth maximization means that the firms make all business decisions and investment with an eye towards making the owners of the firm, that is the shareholders, better off financially, or what we can say, more wealthy than they were before. However, it does not mean that the firm could not pursue other goals. The goal of the shareholder wealth maximization is merely an alternative, or that the firm should enter into a debate as to its appropriate fundamental goal. On the contrary, if the firm seeks to maximize shareholder wealth, it will most likely simultaneously be accomplishing other legitimate goals that are perceived as worthwhile. Shareholder wealth maximization is a long-run goal. A firm cannot stay in business to maximize shareholder wealth if it treats employees poorly, produces shoddy merchandise, wastes raw material and natural resources, operates inefficiently, or fails to satisfy customers. Only a well-managed business firm that profitably produces what is demanded in an efficient manner can expect to stay in the business in the long run and thereby provide employment opportunities. Shareholders are the owners of the business. It is their capital that is at risk. It is only equitable that they should receive a fair return on their investment. Private capital may not have been forthcoming for the business firm if it had intended to accomplish any other objective. Let's look now at the Indian economy and international finance. As we know, the nation has globalized due to certain features they possess, may it be specialization of the nation, or growth of international trade, or opening of the economy, or globalization of firms, or development requirements of economies. Some of the factors are present in the Indian economy also. The first being growth of trade. Since time immemorial, India has been participating in international trade. India's share prior to the coming of the East India Company can be judged from the fact that India and China together were controlling more than 70% of the world trade. The trade declined and went on declining, mainly because of two reasons. One, India was a colony of Britain and deindustrialization had taken place, and secondly was the introduction of factory mode of production. Till independence, India had major trade with Britain. In the year 1950, India accounted for 1.8% of the world trade. India's share to trade declined to 0.57% by 1980. However, in 1994, the share improved a little and reached to the level of 0.61%. Opening of the economy. In the 80s, India economy started opening, but this change was slow and done only on a selective basis. In 1990, due to the balance of payment crisis, India needed to borrow from the IMF. So as India had already borrowed large amounts in various schemes from the IMF and World Bank, so conditionalities were imposed on borrowing. India had to adopt structural reform program of the IMF. The conditionalities require integration of the economy with the rest of the world. In this way, opening of the Indian economy started. The basic premise of the IMF is that once the economy is exposed to competition, it tries to become competitive, and in this way exports grew and balance of trade improves. Liberalizing the trade regime also required adoption of liberalized exchange rate. Consequently, the rupee was made partially convertible on the current account in 92-93. In 93-94, full convertibility of the current account was declared. However, the intention to achieve full capital account convertibility was made in 96-97, but due to the Southeast Asian crisis, it was put on hold and it still has not been achieved. Globalization of firm. It is not only the home country or the developed countries that has multinational corporations or MNCs, but there are Indian companies which have become MNCs. These MNCs have been growing over time. The growing number of MNCs require expertise to provide competitive advantage to the firms by creating value-based financial system within the organization. Development needs of the economy. The Indian economy is a developing country. It has started facing foreign competition. To develop competitive advantage, what does it require? It requires resources for R&D, for import of technology. Development of infrastructure is important from the foreign investors' perspective. It also required for the efficient functioning of the domestic industry. Thus, summarizing what we have done, we find that firstly, finance is the lifeblood of commerce, and responsibilities of the financial manager become broader over a period of time. Secondly, international financial management has a wider scope than domestic corporate finance, as greater complexities are involved, and some of these complexities lead to greater risk and thus the larger need of funds. The significance of international finance cannot be exaggerated, but for sure it is a core factor for the success of the firm. Especially in the absence of local funds, it helps the firms to achieve its goal of success and growth. Globalization also brings along with it a variety of risk for the corporation. As the world is becoming a homogeneous unit because of the flow of goods and the flow of services and the flow of capital, for each transaction there is a corresponding currency transaction which form a part of the international network of payment. So in this scenario, it becomes important for a country to understand international finance, as they cannot isolate themselves from others. International finance management to a great extent is similar to domestic finance, but it has a wider scope. It is different from domestic finance as foreign exchange, risk, political risk, expanded opportunity sets, and market imperfections are involved. Function of global financial manager is not different from financial manager. Broadly, there are two main functions of global manager. One, treasury function. Second, accounting and control function. The main objective of international financial manager is shareholder wealth maximization. Shareholder wealth maximization means firms take all business decisions with an eye towards making shareholders better off financially. Economy is globalized due to certain features that they possess, like development requirement, opening of economy, specialization of nation. India also possesses some of the features which show that India is a prominent player of the international financial system.